Good morning, it's Jeffrey Cohen. It's June 15, 2022, Wednesday. We're going to talk about the markets, and we found something very important. I'm wearing a red shirt because the Federal Open Market Committee, which is a committee within the Federal Reserve Bank, has a very important meeting today where they're going to announce, actually the meeting was yesterday and today, and the Fed's going to announce what it's doing with interest rates, quantitative tightening, and that's going to affect the market. What's interesting is, over the last couple days, I've built my own perspective that says it's less about what the Fed does and it's more about what the economy is doing. And so I'm going to explain some of that. It's also very, very crazy in the stock market right now, and I'm going to walk you through just some very basic statistics that I think are very important to you. So we're going to start with what I found. I found something really important. When we look at debt, so we're going to start with fixed income, you're going to see a lot of new highs and a lot of new lows, and we're going to talk about this. We're going to talk about the extremes in the market. So in this case, this is agency debt, okay? So this is Fannie Mae, Freddie Mac, Federal Home Loan Bank. I'm surprised we don't see the Ginnie Maes and all that. But so if we just look at these, and these are generally speaking mortgage-backed securities, there were 280 issues that declined, 423 issues traded, 280 declined. Of those, 334 reached 52-week lows. So there were more 52-week lows than there were declines in the municipal bond market. So that's crazy. You should look at that and think, okay, that doesn't make sense. But what it says to me is new lows are very, very important. Now let's take a look at bond market activity that's corporate bond market. So this is when companies borrow money, typically unsecured, right? And so they promise to pay it back in a year, in 5 years, let's say. So all issues, whether they were investment grade, high yield, or convertible, 7,251 declined. Of those, 6,454, or what looks to be about 85% of all the issues that went down, hit new lows. So what does that tell me? That tells me don't catch a falling knife. That tells me that we have a market that is skydiving lower. Skydiving. That if it's falling, let it fall. This is very important. Thank you, Tom Fisk, by the way, from Baldwin, Wisconsin, for taking this great photo. Okay? When stocks are falling, they're going to keep falling. So that was equities. Jeffrey, what else do you have to tell us about equities? Well, the other thing I could tell you is that it didn't matter whether you were a convertible equity convertible bond, whether you were a high yield bond, or whether you were investment grade, you went down more than you went up, and you had lots of new lows versus very few new highs. So if you think you discovered America and there's some great company out there that no one's discovered, and it's been dropping a lot, fear of missing out is a low-cost strategy. Let it fall further. So let's go into some of this now. We looked at FinViz, and by the way, thank you FinViz for this data. This is very good data. You really do give us nice visualizations. So how many stocks advanced versus declined? So there were 5,160 decliners, 5,160, of which half of them reached new lows. So half the stocks that went down yesterday went down to new 52-week lows. That's crazy. And furthermore, it's crazy because the S&P 500, see this dashed line? That's where the market opened. So the market opened higher. We called that it would open higher. And actually, it ended because at like 3:15 East Coast time, it started to drop from 2 to 3:30, let's say, and then it recovered. So the market really wasn't down that much yesterday. And yet, 59 new highs, 2,542 new lows. So if you've got a stock you have your eye on, and we did this yesterday, we actually sat in a coffee shop, so my fingers weren't on the keys, and we wrote down all the stocks, there's so many here, all the stocks that we would buy if we were not in a bear market. So many. Freeport McMoran, Cleveland Cliffs, NVIDIA, Flex Steel, Qualcomm, Grow Generation. I'd buy Coin. I'd be all over that. Silvergate, Amazon, Hewlett Packard Enterprise. There's just all these great... And that was just on the first page, right? Wrote all this data. I have all these stocks I want to buy. Oh my God, Procter & Gamble, Coke and Pepsi. You name it. The tobacco stocks. There's so many nice stocks out there, right? And then there's stocks I wouldn't touch with a 10-foot pole. You know, there's so many. And so, but you can't buy them now because there's no support in the market. So that's my so what. I mean, I could end the video right now and you got a message, right? If a stock has started to fall, if a stock has hit a 52-week low, look at that. 2,500 new lows versus 59 new highs. Again, go back to corporates. 15 bond new highs. New high means that the rate goes down, that the risk is somehow better. 6,454 new lows. That's the message of the day. So let's take a look at some of the economic data. Hang on one second. One second. Hey, Bob. Cat cameo. It's time for your morning cat cameo. This is Pumpkin Spice. He was outside saying hello to the birds and the chipmunks. Hopefully not the squirrels because they're pretty rough with him. But, the squirrels come 3 or 4 at a time and they scare the dickens out of him. So he scratches at the window. So let's talk about interest rates. So this is June 7th. So by the way, who is this? This is the website of the Federal Reserve Bank, federalreserve.gov. This is a trusted source of data. It's not political at all. It's not for profit. It's not trying to get you to buy side or sell side. It's just data, right? So this is 5 trading days, ending not yesterday, but day before yesterday. So commercial paper, this is how companies fund for short-term needs. It's 1.02. Used to be lower. That's fine. So it's over 1%. When a company needs to get money, it's 1%. If you're a financial company and you need money, commercial paper for a month, you're paying 1.32. So you're paying 30% more interest rate if you're a financial institution. The bank prime loan rate is still at 4%. The discount window is at 1%. That's the kind of thing that the Federal Reserve manages, right? Let's take a look at a 4-week. Oh, I have to update my model. Oh my God, 4-week is finally over 1%. That's a big deal, by the way, because it affects asset valuation models. Big. I got to write that down somewhere. 1-year money is 2.73%. That's high. That's really high. If you want to give the government your money for a week, they're willing to pay you 2.73 versus 2.15 days ago. Remember, 4-week treasuries over 1%. 1.11% over 1% versus a week ago. Now we look at different things. These are your nominal interest rates, okay? So 30-year treasuries, 3.42%. 20 years are a little higher at 3.68. That could be just a factor of what bonds are available. 3.43% for 10-year. Now we can look at how it's trading right now. The 30-year is yielding 3.36%. The 10 years is yielding 3.37%. So 336, 337. Rates were higher on Wednesday. The 13th, Monday. Rates were higher on Monday. So that's interesting, right? It's interesting to see that rates have gone up, and it will reduce the valuation of equities in models like ours. Let's look at lightweight vehicle sales. Cars, pickup trucks. And if you look, they've come down to like 12.5 million. It's not to say they've never been lower. During the recession, they were lower. They fell to 9. And during the COVID thing, they fell to 8.6. And during the previous recession, they fell to 8.8. But during this recession, they fell to 11.5. So, pretty low. Less activity. If you make money selling cars or doing car loans, you're probably in trouble. Let's look at assets. So this matters because this is what the Fed's going to talk about today. The Federal Reserve Bank is holding assets on its balance sheet. So, forever, the assets were under $1 trillion because that was all you really needed to manage market operations. Now, you look at how assets have come up, and during 2014 to 2020, maybe they were $4 billion. So, it's a lot, right? COVID hit. We jacked it up to 7. So we added $3 trillion of assets. So what that means, I wrote this up actually. Flow of money. Okay, so when the Federal Reserve takes in bonds, it pays cash for pieces of paper. So the banks and financial traders give pieces of paper to the Fed. The Fed takes money from the U.S. Treasury and it pays the banks. Now the banks have all this money, right? And so they can do whatever they want with it. They can deposit. They can stick it with the Fed at the discount window. They can invest it in the stock market. They can make loans, right? So when the Fed tapers or quantitative tightening or gets rid of some of these assets, and you're going to see at the very top there's a tiny little slope, right? There's a tiny little top that might have been hit. Okay, we're going to see in the discussion today what we're looking for from the Fed is to tell us where are you going with this, right? What's this going to look like? What's this curve going to look like? Because when the Fed tapers and takes bonds and reduces its portfolio, in essence what it's doing is it's taking the pieces of paper, the promises to pay, and it's giving it back to the bank or the financial trader, who then has to give money back to the Federal Reserve, who then puts the money in a bucket somewhere at the U.S. Treasury. So the money gets neutralized. It gets just frozen. So I take money from the banks. I give them debt. I give them pieces of paper, and then they give me cash. Now, when a U.S. Treasury matures and they don't buy a new one, the same thing. The Treasury gives money to the Fed, and the Fed gives it back to the Treasury and puts it like in a lockbox. So the money's neutralized. And when there's less buying, then the U.S. Treasury to the Fed, cash, Fed to the banks, there's less money given. Then the banks start to take their bonds, use up their bonds, give fewer of them back to the Fed, right? So I'm sorry, I said it wrong. The banks buy less bonds, get less bonds, and then also less cash. I'm not saying that right at all. I'm so sorry. Basically, less buying means less cash goes to the banks, and that's a problem, right? So it tightens. So I'm sorry, I'll do better next time on that one. So what this is really telling me is we need to see whether they can take down where they're at. Now, I tweeted earlier, I think it was yesterday, that the Fed could easily taper back down to about 7.9 trillion. Take $1 trillion out. So there's about $30 trillion of money in circulation in terms of M2. Deposits, demand deposits, fast money. 30 trillion. So if you take $1 trillion out, you're taking out 3%. You're doing a big deal to get inflation down. All you got to do is take it down to 7.9. It's where we were May of last year. So it's a year ago. They can do it. This is the finesse that I'm hoping to see out of the Fed. I'm not sure I will, but I'm hoping to see it. So there were a couple other things I wanted to cover just as the market's going to open. Bitcoin continues its relentless decline. It is now at 21,100. Remember, support on Bitcoin was 30. It means it could also bounce back to 30. Ha! We were just kidding. But remember, support was at 30. Bitcoin's now at 21. That's pretty low. And if people were relying on Bitcoin to have a certain amount of value, let's say they had it as collateral, or they borrowed money to buy Bitcoin, or they used rent money to buy Bitcoin, dude, this is a problem because this is going to shake out a lot of weak hands, and there may not be any new hands. Let's look at foreign exchange. It's important. I've learned how all these things kind of come together. So the dollar, again, strengthens against the Canadian dollar, right? Flight to quality, so to speak. U.S. Japanese yen has been stable for the past couple of days, but you're talking about, I think it's 20-year highs for the dollar against the yen. We also noticed, by the way, that the Chinese yuan or renminbi is also, the dollar is very strong against the Chinese currency. So these are economies that are working really hard to make sure that they can sell to the United States. Look at the euro dollar at 104.5. Again, this is Europe making sure it can sell into the United States. It also could reflect a flow of money, a flight to quality or a flight to safety back to the U.S. As the U.S. raises interest rates, people want their money in a U.S. bank. You get more interest. And so when that happens, when that influx of money comes to the U.S., which we're asserting to be true, I don't have the data to show you, that's when the exchange rates change, right? Money comes into the U.S. Let's take a look at the futures. How are we looking this morning? So the equity indices look good, right? They look like we're up. So you're up 1% on the S&P 500. You're up over 1% on the NASDAQ. And on the Russell, you're up 1%. Okay. Looks good. Looks like a market up, market open. By the way, I'm wearing a red shirt because the Federal Open Market Committee is issuing its results at 2 o'clock Eastern today. And I think anything that happens with the market right now is just a head fake. So the VIX, you can see it hit almost 30. It hit 34 yesterday, but it's trailing a little bit lower. So my guess, we ran the model yesterday. I haven't had a chance to look at it. Is that you're going to see increased volatility, increased variance in all your stock market exchanges. We could do a quick look at the end of the video. Just shoot me a chat. Let me know if you want to see stock market variance figures. Go ahead, ask me anything. I covered a lot of ground. Let's cover some more. Mortgage-backed securities. Jeffrey, what are you doing talking to us about mortgage-backed securities? Why do I care? Well, let me tell you why you care. You care because the average mortgage versus a year ago, it's awful. Where's the data? I just saved a whole bunch of data about mortgage-backed securities. Here they are. "30-year mortgages, according to this author, Mish, hit 6.13. I want you to think about that. A fixed rate mortgage hit 6.13%. Guys, I remember they were 5. I remember they were lower than that. According to Mortgage News Daily, fixed rate mortgages hit 6.28%. Hey, honey, let's go buy a new house. You know, I love this house, but I'd like a bigger one. Okay, honey, let's go. Let's get $1 million home. Oh, yeah, $1 million home. Let's go. Oh, wait. I got to borrow $1 million, and I got to pay 6.28%. So that means I got to pay $62,800 in interest. So, honey, do we make that much on our YouTube videos? Well, no, we don't make anything on YouTube videos. How about running the job for clients? You get paid $750. Yeah, that's going to take a lot of runs for that. How about I work 400 minimum wage jobs? It's a lot of money, right? And property taxes, at least anecdotally, what I hear, property taxes are going up. So your $1 million home, $62,800 of interest on that $1 million, plus your property tax on a $1 million home is probably another $60,000 a year. Maybe it's $10,000, $20,000 a year. It's a lot of money. So you just made homes less affordable. But what it also does, and this is important, is it makes the value of existing mortgages go down. If we look over 5 years, I just want to show this to you. This is mind-numbing to me, right? Your mortgage, this is an ETF, an exchange trade fund that tracks mortgage-backed bonds. It traded high like 27. 2020. It hit 26, 25. By the way, new lows, 24, 23. Looks like it kissed 22. I don't know about you, I think this is crazy talk. Mortgage-backed securities are down 5. They're down 20%, 22, 25%. This is unfathomable to me. Let's take a look at the Treasury Bonds. Same picture. Let's look at a weekly. Let's go daily for a year. 2 years. Weekly for 2 years. Right? So your 30-year, your 20-year plus, right? It was high. It was high. I mean, you used to be able to put your money away, and it was almost no interest paid after COVID. And it came down. There was a taper. There was a fear that they were going to balance things, right? They were going to try to taper the bond purchases. So it dropped to 135, which is an important support level. Actually, 137 was our support level. 135 and 137. You can see it went up to almost 150, 155. Now it's down to 108. I just want to zoom in a little bit. I want you to see how much of a decline we've had this year. 20 plus year bonds trading at 150. So if you held those bonds, you lost about 20, you lost 41 on 150. You lost about 25% of your value on any long-term bonds. So your mortgage-backed securities went down, and your bonds went down. That matters, doesn't it? That matters a lot, actually. If you're in a business where you invest money in mortgage-backed securities and you invest money in bonds, long and medium-term bonds, your portfolio is in a fair amount of trouble right now. And so, I mean, let's pray. Everyone, let's get together in a big circle and pray that the Federal Reserve lowers interest rates. Because if you hold mortgage-backed securities and you hold bonds, long-term bonds, and the Fed says, oh, we're going to raise rates. They're talking about raising rates 0.5%, 0.75%. Let's go a whole percent. You're going to destroy the companies and the people, the old people, the conservative people that hold those securities. I just want you to think about that for a minute. When you think about falling through space, Thank you, Tom Fisk, for making such a great picture again. I really appreciate that. So that's how I'm going to leave you. I'm going to take a quick look at some of the indices because, we like to do that. Look at that S&P 500. Don't catch a falling knife, people. Let it fall. It's okay. It's okay to miss the exact top or the exact bottom. And just let the thing fall. The Fed's not going to have good news for anybody. It's not. Money managers. How we doing pre-market? They're up. Oh, Franklin Resources. Ben. Up 11% pre-market. So that's exciting. Fixed income. They're excited about fixed income. Maybe they didn't see the data that we just showed that fixed income's down 25% the past within this year. Maybe I'll have to call them up. High beta stocks. How we doing pre-market? Got some down. Not down very much. And you got some up. And the ups are bigger than the downs. Specialty retail and furniture. Right? This is my bellwether on whether the economy's doing okay. Because do you really have money to go to buy Chico's? Expensive dresses and work clothes? It's up. It's up. Not a lot, though. It almost feels obligatory. Like everything's rising just a little bit. The declines, just like Robinhood's down 2.5% pre-market. Okay. Do you know Robinhood is trading below book value? Are you kidding me? But don't catch the falling knife. So this is my point, right? And this I'm preaching now. Let me preach. Oh, let me preach. Lord, take me now. Robinhood. Hey, Jeff, man, it can't go any lower. Look at this stock. Look at the stock, Robinhood. Right? It was $75 a share, Jeff. I got so much money to make. 45, and then it hit 37, but it was a deal at 37. 27. Oh my God, I should have bought some. It was down more than like 2/3. Jeff, at 18. I gotta buy it at 18. This is the best deal in town. Oh my God, 11. Jeff, Robinhood cannot go lower than 11. Never. It was $75. Oh look, it popped up to $12.80. Everyone better buy. No, man. Then it hit like 10. Then it hits 8.5. And I'm sure everyone thought, oh, I'm gonna buy the dip. Look at that green. I gotta zoom in. We gotta buy the dip. At 8.50. It popped to 10.60. Well, guess what? It looks like it's kissing $7. $75 stock kissing $7. It's trading below book value. It's a steal. I bet you could write a whole thesis, a whole page in a blog somewhere about how Robinhood's such a great stock. But it's not a great stock when it's dropping another 2.5% this morning. It's not a great deal. Let it drop. It could go to $1. It could go to 50 cents. No, like it really could. Like don't think that it's going to stop dropping because you bought it, right? I mean, what a great example. So let's look at another one of my favorite examples. I got burned so badly on this stock. Okay, pre-market. Let's look at Hydrofarm. I don't have any love at all, any experience with Hydrofarm. We're going to take a look at Hydrofarm. So let's go back. Let's go 5 years. Let's go 5 years weekly. So you look at Hydrofarm and you think, oh, what a great stock. Hydroponics hit $92, right? Look at that. Relentless climb. And then it drops. So let's say this is our support. This is $50. So it's a $50 stock. I love it. They buy up brands. They're helping to grow cannabis indoors. So the stock's a $50 stock for a long time. until September of last year. And then it dropped, but it came back up. It was $40 stock. Then it dropped. Then it was a $20 stock. And then it dropped. And really here I would have thought it was going back up again. 17. I would have made this bet. 9. 6. I actually tweeted with somebody who told me that they bought it at $9 and they were thankful for the opportunity. And I told them, just please save your money. Hold your money. And they disrespected me like I was a school child. Jeff, I just bought it at $9. I love the stock. There's a little dead cat bounce at 7. Now, she's up to 456. So you could argue, oh, maybe we hit the bottom. But how do you know? I would have said we hit the bottom at 40. 30, 20, 10. Dead cat bounce at 7. It's got to be a steal at 7. But if you bought it at 7, it's now 450. My point is, don't do it. Don't do it. Corporate bonds, 15 new highs, 6,454 new lows. Agency securities, 5 new highs, 334 new lows. Everything is on sale. Everything is dropping. And now what? The Federal Reserve is going to save us? They're not going to save us. It doesn't even matter what they do. The Federal Reserve accumulated $9 trillion of assets. The number used to be $1 trillion. They're going to have to pop the bubble. And they're going to have to basically take the money back. Now, they could take 3 years to do it. Took them a while. 2008. So it took 14 years to accumulate $8 trillion. Even if they said we're going to take 8 years to give back the 14 trillion, that's like $1.5 trillion a year. For 8 years. Just think about taxing our economy by $1.5 trillion a year. So of course our economy grew. Of course stocks went up. They're going to have to unwind, right? I mean, maybe it's no big deal that the Fed owns $9 trillion of assets, but it's not the norm, and it pumped up the economy. So, this is the chart of the day, not rates. I showed you rates. You can't get excited about rates. Oh, 4-week treasuries are at 1.11, Jeff. The sky is falling. No, not really. But if I'm a financial bank, then I got to pay 1.32%. I'm still not scared. If Chicago Quantum could borrow money, the commercial paper window at 1% a year for 30 days, I'm not scared. That's fine to me. Because I could turn around and take that 1.02 and I could lend it right back to the government for 1.11. I could make 10 basis points all day long. Let's borrow an infinite amount of money and make 10 basis points or 10% of my money in a year. Done. I'm sitting on a beach somewhere. These rates don't scare me. Even 30-year rates at 3.42 or 30-year rates at 3.37 don't scare me. Right? A mortgage rate. I'm bringing this all together for you because I think it's important. A fixed mortgage rate at 6.3 doesn't scare me. I'll just buy a small house. I could fit in a $200,000 house. Maybe I got to be a little farther from the city. Maybe I'll get some land. Maybe I'll have some trees, right? It'd be nice. I'll be out in the woods somewhere. On a $200,000 house, 6%, I could live on that. So you don't buy the $1 million house. Everyone downsizes. Oh, we didn't even look at gasoline. I'm so sorry. I'm talking all over the place here. We didn't even look at gasoline. Gasoline dropped to $3.95 a gallon if you bought it in 42,000 gallons at a time. That's interesting. So gasoline's coming down. Finally some good news, right? So something's going right for the average consumer. But in general, things are not. Things are not moving in the right direction, right? Copper is down to $4.15.50. We were tracking that thing. Take a look. It did drop to almost $4, but it's gone up to $4.60. Copper is used in so many applications in business, right? So when the economy is doing well, copper at $4.75 is not an anomaly. Copper above $4.50 is very normal when the economy is strong. When copper drops to $4, you're starting to be pretty weak, right? You're starting to say that I don't need copper. I'm not going to make electronics. So, all right, I want to thank you for listening. There's a lot going on. Let's take a quick look back as I wrap up at the futures. How are we doing, Jeffrey? Futures are up this morning. Market's going to open green. Remember, 2 p.m. Eastern, 1 o'clock if you're Chicago Quantum Time. The Federal Reserve Bank, the Federal Open Market Committee is going to talk about what it's doing with balance sheet, interest rates, and the repo window, what they're going to do to keep banks liquid. And I think that's when the real action is going to happen. It's going to be very quick, very quick. There's going to be like pre-programmed stuff about what they do. And just don't catch a falling knife. Just wait. If your stock is down, if you've got a list of stocks that you want to buy them, you're desperate. Just wait. Just wait. And then last but not least, we are doing something with regional banks. If you're interested, give me a call. I may charge you. I have a list of 20 banks that are actually in a good position right now to make a lot of money on. But you'd have to call me on that one. And you can find me through the website, chicagoquantum.com. There's a contact page. Give me a call. Shoot me an email. I'd be happy to collaborate with you on a ton of fundamental research on regional banks. All right, hit the subscribe button. Drop a comment below. We can chat away. And good luck in the markets today. I hope you make money. Please stay safe. Bye-bye.